sure the audio's working properly. Can you hear me? Yes, we can. We're okay. Lighting okay. Everything okay. Good morning. Good afternoon. Good evening, wherever you are. It's 1:15 here in sunny London today. We've actually got a bit of sunshine. I've been out this morning looking at the blue sky. I forgot what it looked like. It rained all day yesterday. It was typical miserable winter's day in good old London town yesterday, but it's beautiful today. For now, it's only a daily respite, a bit like the markets. We got ADP private payrolls in literally a minute's time. I just wanted to start here next to me. This is the gold chart, the 4-hour gold chart. If you can see that, let's make my great big head a bit smaller. I could do the hair wash. Can I look at that? There we are. Let's zoom this up a wee bit. So here's our monumental sell-off last week, Thursday, Friday, all the way into testing that 4,000 under that 4,500 level. There's our January open here, the close of 2025, 4,320. We've bounced significantly through the 23, through the 38, into the 50. Next stop is the 61.8 key fib level of just the sell-off, and that sits at 5,150. Key thing today is we are over $5,000 for the first time since the hoo-ha of the sell-off. There's 5,000 big purple dotted line. So we went through that yesterday morning, and we've held it into close yesterday, and we're up again today. This is the hourly chart. Let's just make that a wee bit bigger for you, and stretch it a bit. There we are. For the rally so far today. So holding in the upper half of the Bollinger Band remains positive here on this mean reverting strategy. It's crossed to the downside. So let's just bring in the calendar today. This is the chart of the ADP numbers. So it's been weakening for over a year now, private payrolls, but we obviously lost all that data. The actual last night, Trump signed off the government shutdown, so the data will be relaunched, but still doesn't look like we're getting non-farm payrolls on Friday. So just looking here, ADP down 9%, even though they had blockbuster earnings yesterday. ADP down 9.5% pre-market. Anyway, let's have a look at what these numbers look like in a minute. So the trend is being to the downside. Last time we were 41,000. Last month we were 41,000. I just got on the forecast. It's not working. Isn't forecast. So forecast last month 34,000. So let's just have a look at that. So ADP is breaking now. It's 22,000. So it's much less than expected. It's less than half what was expected. That's going to add to the momentum story about the weakening jobs market. But is it really going to impact the economy? That's really what obviously the Fed have got, the conundrum the Fed have got. So 22,000 here for non-farm payroll from the private sector. Remember, we're not getting NFP on Friday. It's even turned off the calendar now, isn't it? Turned off the calendar? Yes, it has, because it's not happening on Friday. So that's all we've got to go through. Remember, that's all we had during the record shutdown. So service provider jobs rise 21,000 of that 22,000. So manufacturing, although we saw that peak in manufacturing PMI, the peak in manufacturing PMI last week, suggesting that things were coming back, and that could have been a potential tipping point. We had sort of big diversification in the Dow and the Nasdaq yesterday. Big sell-off yesterday. The S&P was down 59.6917. The Nasdaq lost 1.43%. It looks like the futures are down again this morning as well. 10-year yield was at 428.35 this morning. It's come back down to 426, but it's still, remember, 4% was what Bassett was aiming for on the 10-year, the key 10-year. So it's less than what was half of what was expected. This is relatively clean data, and I'm just seeing the numbers running over the Bloomberg terminal here. See if I can get into the website. And of that 22,000, I say 21,000 is in services and only 1,000 in the manufacturing sector. So it's a big miss and quite disappointing. Um, ADP, obviously, more of their survey is in the service sector. But let me just run through some of these. So last month has also been revised lower as well from 41,000 to 47,000. So that's quite a significant turn down. Goods was positive, although it was negative. It was actually contracted last week, so last time. So that's a bit better than the headline would read. But small businesses, no growth. Medium business, 41 compared to 34 last night. So large businesses shedding 18,000 compared to a 2,000 increase. We've had all those job losses announced both by the banking sector and in their earnings numbers and the technology sector. 30,000 going from Amazon, remember, over the next 3 months. Wages for job changes plus 6.4% compared to 6%, 6.6%, and for stayers 4.5% compared to 4.4% last month. So if you've got a job, you're doing okay because you're way not way above, but certainly above uh, goods inflation, but people aren't feeling it. That's the key thing. That's the problem that the president has, the administration has. Some of this data has been quite positive. As I said, the ADPs earlier in the week, this number here, 52.6, best number for a long while. Look at this, 52.6, back into expansive mode. Last twice we went into expansive mode was spring of 24, and this time last year, 2025, February last year. But it's a big old lift, 52.6 compared to this period of recession in manufacturing. So is this the turnaround? Is this the pivot point that many are talking about, that we've been talking about this week for the US economy, and particularly that manufacturing rehoming of or re-onshoring of jobs? But how many jobs is it going to really take? And again, we had that classic move on Monday. We saw the uber exuberance in the commodity markets, particularly silver and gold, which had been completely got really parabolic, really overextended, came down. And then yesterday, we had that big worry following Anthropic's story sparked the sell-off yesterday in the technology sector. I said the Nasdaq was down. Let's just bring in the Nasdaq. Oh, you'll come back to everything else. The Nasdaq down really significantly yesterday. We've got the daily candle, a monster 1.43% decline yesterday. So that was, we keep talking about this consolidation at high still being good, but the bodies of the candles are getting bigger, my friends. And look at the last week. Look at the size of the negative candles. We're still above this low, this 25,000 level, but that looks like it's going to nothing's inevitable in the markets, but that to me looks like it's going to get tested quite strongly potentially. But who knows? It's all guesswork in a sense because we make our money in this part of the charts, don't we? And that's where we live and breathe. Yeah, but that sell-off was quite significant. Big volatility we'd seen on Monday from the collapse of the commodity markets and the bounce back we've seen. So are we going to see a buy on a Wednesday today? But it's looking a bit, a bit messy here at the top. And if we do another, if this is another leg that's over, which it certainly looks like here on the daily time frame, I know there's lots of. Just bear with me a second. I know there's lots of fib levels on here. You'll be going, "What's he doing? Silly old bugger." But that's the down leg, and we've collapsed through the 50. We collapsed through the 38. There's the 61. It didn't. It didn't. Hang on a minute. It didn't. We want that low. It's there. If that and it's too early to say that this leg is over. But if we take yesterday and put it on, Monday's sell off and yesterday's took us all the way down to the 23. So big move to the downside. We didn't find any support at the key 68. In fact, we found resistance to the upside. So this is still looking relatively negative when we opened at the 61 of this. I say it's a bit too early to call that as a leg from the high there on the 28th to the low on the second, but certainly the resistance held at the 61 point, and we rejected it yesterday big time, and then just crashed through these other levels. We didn't hang around. We sort of stepped down the time frames and see. that in a bit more detail for this last leg. So there's our leg retraced to the 61, found resistance, and then moved back down again. So um, weakness, and 25,000 really is calling, I would say, there on the Nasdaq on this short term basis. But again, assume this, take a step back. We go up to the daily time frame. We've had a fantastic rally, uh, and we're just this consolidation. The longer it goes, the worry for me as a technician, the longer this goes, the sell off could be quite dramatic, and a bit more aggressive than we saw here in November, because certainly February tends to be a weaker month than November traditionally in stock markets. And However, the caveat remains that the earnings have been good, but they're being sold off. Like we saw that strong number from ADP yesterday, AMD yesterday, but we're down, what I say, 10 and bit percent. Eli Lilly is up 10% pre-market. Novo Nordisk down 4%. Pharmaceuticals today. Also, last night we had Merck and Pfizer also reporting quite good numbers. They moved with less volatility. That was the blockbuster headline grabbing drugs the other two have, but Merck and Pfizer good numbers yesterday. No just getting sold off. So Nasdaq, big day down. Yes, let's do the other dollar indices. I said the Dow lost a third of 1% yesterday, so less of a massive volatility yesterday. None of this volatility yesterday on the Dow, but we recovered quite significantly into the close. We just look at the going to the 4 hourly chart yesterday. Big recovery yesterday, and then weakness after the US. Sorry, big recovery yesterday to kick off, and then weakness into the after the US, after the European close here on the 4 o'clock candle. So 4, 5, and 1800-hour candles were all on the downside into 49,950 before we saw some buyers into the close. I'm saying the close of the this derivative market, and then we moved a bit higher today. We can see this zone here on the hourly chart at 49,500 is holding to the upside here on the Dow. So we've got sort of big diverse, sort of disparate moves in the Dow and the Nasdaq in particular yesterday, and I say the most important of all, the S&P closed 6917. Derivatives now is at 6928. So again, similar pattern to the Dow. Big sell-off post European close. Yes, that was nice trading last night to the downside, and we bounced a wee bit. So stocks remain weak from that Anthropic technology spiked move. As you might expect, given that it's the technology companies, these AI software companies got hit significantly yesterday. So it was commodities on the software companies yesterday. Is it all just part of the froth? Are we now looking? This is a key thing. We've been saying this for a while. Is 2026 going to be the year where we're trying to see at least some sort of partial return on these enormous capex numbers? This gobbling up of all the power, this gobbling up of all the data centers, creation of data centers and hardware. It's got to get fed. The commodities run ahead of themselves or ran very, very hot. The valuation of some of these companies is eye-watering, and I'm one that's lived through the tech bubble of 2000, 1999 and 2000 and onwards, and that took 2 or 3 years before it got back to where it was, but it obviously got back and moved even higher. So, certainly won't too much. The Nasdaq, nice and volatile, great for short-term trading. So crypto remains woeful. 75,000. It's gone even lower this morning when I first looked. So we're tripping lower here. This was yesterday's 6 o'clock candle, and the 7 o'clock candle went to 72,800. So that is worth a little intraday line, certainly from here. Is that online? No, it's put on just a rare because it's just an intraday one. To be red, but again, make it all one. So make a note of that. So third to low. sub 73k. So 70 keeps calling to the downside, doesn't it? That's our low yesterday. Recovered a bit today, but again, back over the 75 handle, which is this key big dotted line here, but you can see the lines and the trend continues to decline. 4 hour, some big down 4 hour candles here. Average in the 20 period moving average yesterday. Big down yesterday on the US Open and a little blip here. Having gone under 75,000 and closed under it for 2 4 hour candles there. That's key. Obviously, the daily is yet to do that, but that's what the bears will be looking for. We've had one, two, three, fourth day here, just above, fifth day here, just above the 75,000 zone. But that again, that looks inevitable as the week moves on. But it's been quite a violent move down, so maybe some buying. We thought maybe temporary buying at 85,000 did not happen at all. Previously, we've had support here in November, middle of December, but no support at 85,000 in the January towards the end of January in the January sell-off. So we're into seven. That's just becoming relevant. The intraday low was burst through irrelevantly again at the end of January. So that 80,500 collapsed as well with it. So within 2 days, we've broken those two key support levels. And then 3 days later, we were testing the 75,000 level. Nasser Hussein, hello, my friend. I've just seen you here. Sorry. Good afternoon. 2 minutes. So, what about tomorrow's labour data protection? It's not happening. The non-farm payroll is not happening because of the government shutdown. Okay. Tomorrow? You mean the weekly? You mean the weekly number? Weekly number. Let me just bring the calendar back in. The weekly number. Gold prices. We said at the top of the shop. I don't know if you were here, but we've go back to gold. Everybody loves trading gold, don't they? So obviously, I won't talk about the massive rally. There's the sell-off from last week, Thursday through to Friday. This is fib of that leg, if indeed it's over. I'm saying it's a bit early to call, although we have bounced significantly yesterday. That is a leg from the intraday low down here at 4,410. The intraday all-time high we got to at 5,600 just last Thursday. What a week we had! Thursday, wasn't it? Yeah, the 29th. Yeah. Um, crazy man, especially on the gold market. But yeah, central banks are back in the market buying. So we've strong bounce yesterday, another up day yesterday through the 5,000, through the 50% of this leg, this panic leg sell. And that sits at 5,000. That's the 5,000 level. So holding 5,000 will be key going into the rest of the week, Hussein. And the next resistance, I say, is that key, the golden ratio here, if you believe in the Fibonacci levels like I do. 5,140 is the next upside target for gold if this continues, this 2 day bounce continues. So that's the upside. You're asking, what about the labour data prediction tomorrow? Are you talking? Sorry, let's bring in. Where's my calendar gone? Bring in the calendar again. So tomorrow, I mean, the market moving events tomorrow, and not that Bank of England or the ECB are, well, they are gold buyers, obviously, but a lot of gold bullion. The LME in London is key trading for gold. So what the Bank of England are doing, affects FX, so affects hedging situations, or whatever. If you're talking about the weekly claims have been really strong. Let's just have a look. Actually, let's just have a look what the BLS has said. Um, um, about probably haven't updated website because it's read more Spanish Federal Services. This website is currently not being February the 2nd. No, so Trump signed said that things aren't get rid of that. There we are. So really, the market moving events tomorrow has said are these two central banks. Pressure. It'd be interesting to see what both say. Neither likely to change certainly interest rates, but the key thing, certainly in England, in London, the 12 o'clock session will be the what the vote split looks like. We were expecting 2-7 last time. We didn't. We got 5-4. So that's a really, out of 9 people, five wanted to do one thing, four didn't do anything. That's not, that's good. I mean, that's good for the committee. It's good for economic and intellectual discussion. But it's not from making a field. But certainly, yeah, I mean, Hussein, you see from India. India, we're getting into the India's not really part of the Lunar New Year, but obviously you're in it, so the ripple of the Lunar New Year in Southeast Asia and China obviously has a ripple effect. We're coming into the spring session, big wedding season, isn't it? In India, Indians big buyers, physical gold, jewelry, watches, rings, and obviously giving us wedding presents. Part of your culture, part of your Hindu religion as well. Goals absolutely fundamental. But obviously, come back to Europe and two of the biggest central banks are reporting their interest rates. So that's going to have a bigger impact. Claims will take place tomorrow, I think. They're Department of Labour, isn't it? So that may not take place tomorrow. So it might not happen. So the main news tomorrow, which is always going to be the main news, was the Bank of England. They're out, and Mr. Lagarde and the gang over it. Sorry, am I speaking too quickly? I tend to speak. I get far too excited. Sorry. Um, and their outlook, what she says, but again, there's no pressure maybe on the upside for 2026 from the ACB rather than cutting rates, like we saw from the Central Bank of Australia, the RBA, the other night. So, and again, just on tomorrow again, we'll talk about more of this tomorrow. We've got a key speech from Bullock, the governor of the RBA, late tomorrow night as well. I'll be probably in bed by now. I'll be watching that. But if we've got any Aussie trades triggered on my end of day platform tomorrow, that could be impacted by these two speaking. Now, I think I've got Aussie CAD. Yeah, Aussie CAD. I was long this morning. I think it's sort of just about in the money. I was long Kiwi CAD and short pound Oz yesterday. So perhaps not pre-looking what Bullock might have to say later on following the rate hike and the more hawkish outlook from Australia on Tuesday. So yeah, I wouldn't worry too much about the labour numbers tomorrow. Let's go back to today. The non-farm payroll has been a big miss, less than half of what was expected. Last month was downgraded. 22,000. Let me just reiterate: 22,000 of that. 21,000 of that 22,000 is in the service sector. So manufacturing still turned positive, as we said it, because it was negative last month, and we saw this positive reading, this multi-year high for the PMI manufacturer, and that's forward, so that's positive. This could be read as really positive. So again, the spin could be taken that is actually positive news. Finally, after the hoo-ha, the tariffs from April last year with Trump's predictions, we could be arguing that the data is trying to support that. The inflation numbers remain quite muted, but CPA will be key again at the end of this month because it'll be cleanish. But we've had another not a 3 or 4 day government shutdown, so we'll read into that once we get it. But the negative was that reading last week. I'm going to get another reading of it this week on consumer sentiment. The Consumer Board consumer sentiment we saw last week, CB consumer sentiment, look it up, was the weakest since 2014, even worse than the COVID crisis. So interesting what the University of Michigan, the business school in Chicago, is going to come up with on Friday as well. Watch that. 55 is expected from 56.4. This has been remarkably resilient. We'll talk about this consumer, but as you can see, clear weakness from the summer last year. The enthusiasm of the new Trump regime, the nadir of April and May, and that's what we might be looking for to the downside if we get under 50 again. But 55 is expected, 56.4. It was better than expected last month. So, and again, this is the first reading of it, so it's the most volatile market. So, plenty of action. I know it's quite late where you are it's a Friday evening for you, Hussein, but yeah, be careful. Sir, what's he saying here? Sir, I have I bought silver at 100, but it was fallen till 78. Now it's 90. Yeah, I mean, as I say, I don't know if you're a long-term holder. Should I hold or will it fall more? I'm not allowed to tell you what to do, Hussein. It's really, as with trading, um, should I hold it or will it fall more? Well, the thing about silver is it is actually historically, it is more volatile than gold. Everybody focuses on gold because you feel it touch. Not that you can't with silver, but the uh, silver, gold is predominantly a precious metal. It's not used in industry. Obviously, it's used in um, key demand for that as well. But silver is much more of an industrial metal. It's more difficult on the supply side to figure out where it's coming from because it's not just silver mines. Obviously, the gold is found in certain areas of the world, certain obviously key gold miners, so you can monitor. You can invest in gold either through an ETF or buying the actual gold miners or trading these derivative products as they go up or the bullion or whatever. And same with silver, but production of silver is not just silver mines; it comes out of copper mines as well. It comes out of some other base metal mining as well, and it tends to be more volatile. I can't do it here, but if you plot the volatility of gold and silver together, silver can move twice as aggressively as gold does. It gets overlooked. Copper is another one. Copper has been difficult to trade in the traditional derivative CFD market. Used like 5 times the value, and the values was very different to what the actual commodity tonnage was trading at and stuff. So I'm not, it's expensive to provide the feeds because not many people trade it, so it never got really traded much in the derivative, our retail market. But as you can see, we've had a massive, massive run. If you bought at 100, hugely psychological, but it didn't stall. The key thing I'd worry about the 100 level for you, saying again, I don't know how long you're holding it for, but yeah, again, if I do the same thing we did on the gold market, the same levels are in place. So this was our top at 121.26 on Thursday. This is our low from Monday. There we are. We're stuck today at $90.80, which is a key fib level. People, derive. I love it because it is like magic. It's like, why does it stop there? Well, that's why it stopped there because there's a key fib level there, 38.2. These are the three main levels on this on the Fibonacci retracement tool: the 38.2, the 68.1, sorry, the 50%, which isn't really a fib level, but in financial trading and financial markets, being added to all the indicator tools, and it becomes self fulfilling. However, as you can see there, the $100 level is a hugely round number, hugely psychological where you got in, and the 61.8 retrace of this down leg sits above that. I think that's why that purple line's there actually. 102. So 102 is the upside target for those that have bought down here, I would guess. But first, money might get taken off at 96.82, then 100, and then 102, where the 68.1 fib level can be. And they can act as resistance levels. So, like lines on the chart, the price can stall at these levels. Before that, because of this big hoo ha, we've got the 20-day moving average, the midline of our Bollinger Band there at 93.46. So, you've got 4 key levels to the upside. So, it's your call. I can't tell you what to do. But clearly, there was buyers as we went all the way down to 70, and it's bounced quite aggressively. But as you can see, we've only retraced 38, less than 40% of the big sell-off we had, and it had got very quite overbought. If we look at this chart on a different layout, if I just use my moving average, go up to the daily chart. This is the same silver chart on the daily time frame. Massive, massive, massive clean right. You see that's clean, big old through the 20 day, and there's that resistance here. This chart. So this has been long, 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 all the way from back here That's the last cross of the 5 and the 9 20-day moving average on the 10th of November. So simple trend following tracking software. Sometimes I say this all the time. People just look at me and think, "You mad, you old silly old bugger." But the simplest mechanical systems can, when you get a trend, it can run and run and run. I said, and everyone else is watching. As you can see there, the 5 and the 9 moving average last crossed positively here on the 10th of November, and they haven't gone back across them. So they've been in a line, they've been in alignment, and that's what we want as trend followers. So thank you, thank you, thank you very much. We then had that massive sell off on Thursday, follow through selling on Monday. Sorry, it's Friday, wasn't it? Volatility on Thursday, massive sell off on Friday. We got the first signs that something was up on the 26th there. Remember that massive rejection of higher prices, but then we still had exuberant buying, exhaustion buying right at the top there. We got a nice three candle top there. See the top there. Lower high, lower high, high high, pivot turn there, and bang. Obviously, you didn't know that was going to happen until afterwards, but then there's follow through selling on Monday. We bounced Tuesday, and we're currently bouncing on Wednesday. But as you can see there, we're stuck still under that red line, and that red line is the 21 EMA, which many people use. I've used over the years, and you say but you wouldn't be buying this yet. But just going back to your so the same thing. We do the same thing here with the fib level. Prices are all the same, so the technique is the same. So again, there we are. Bit cleaner on this chart, isn't it? So I hope that helps you, my friend. It's your call whether you hold it or you sell it. But obviously, you're clearly out the money, and how much pain that's causing you, I don't know. I don't know how if you've bought a physical commodity, if you're trading it with a broker, if you've got an account with us, what you have. But anyway, thanks, Hussein, for being here, my friend. Any other questions about anything else? Let me know. But that's gold. It's got some key upside targets, and you see that resistance at the 21 EMA, $91, 50, 61, 8. You can see the numbers, hopefully. You see that. That's 102. You get back to break even, but 50% of the sell off is at 96.25. And the key 40% of the 38.2 in Fibonacci terms is $90 where it is now. And again, round number, is it going to break through that? So there's some key resistance there as well. So that's my take on gold for you. Saying, where was I? What was I doing? We've done crypto, we haven't done the forex yet. We've done gold, and we've done the indices, haven't we? So it's all energy. 63. Oh, pretty nice. The lift. Let's go back to my line with the chart. So we're holding again. Let's choose this chart to start off with. First breach was back here, 13th of January of the $60 level. Didn't look like it was going to hold, but for now, in fact, it's here, isn't it? Because it went under that. So 1, 2, 3, 4, 5, 6, 7, 8, 9 days. We've been above $60, which is a key level. There's Friday's hiatus, and Monday's gap on open. So we're going to go higher. This needs to be filled with the bodies of the candles. Down day Monday, we bounced yesterday, but we closed below Monday's opening, which is key. So this is quite a negative setup still. But as you can see here, hopefully on these simple moving averages again, we're above the 20-day, and we have been since this first burst through here, the 8th of January. Sorry, through the 8th of January. And our 5 and our 9 have yet to cross again. So the green line is the 9 period moving average. See up here. And the orange line is the 5 period moving average. So these are 3 exponential moving averages. It should be in alignment if they're trend following. When they're flat and crossing and recrossing, there's no trend, so you stay out. You want to be, above the red line on this average. The rule is, again, 2 simple rules on this strategy. You look, first trigger is the cross of the 5 and the 9 from above or below, depends which way you want to go. So the 5 needs to cross from below to above the 9, and then the next trigger would be, so that would have triggered an entry there on the 5th of January. Initial stop loss would have been down there because that's the turn in the market. You would have been, worried about it being there. But it immediately goes down, if you kept your stop loss here, you'd have still been in and you'd have caught this rally. Most people, and I guess I would have been the same, would have pulled their stop loss up and been stopped out. But that would have been your next trigger there, the 8th of January. And again, that's been up, might have come, hasn't gone under the 9 period there, has there an intraday, but it hasn't closed under the midline on an end of day basis until today. So that entry there from the 8th of January would have stayed with you until then. You would have got out there on the close of the candle on Monday at 62.38, where you were on the 20th of January, 62.38, and you've missed out on that. But that's what trend following strategies are like. You don't get the whole of the run, but you never get the whole of the run. And if anybody tells you you do, they're lying to you, my friends. Or what you want to do as a trend following trader is get a big portion of the trend, and that's what we've got there. So you can see we'd got in there, it had got in there, the system had got in there, the trend got in there, and we've kept it there. So we've got that amount of the we got that amount. See what I'm saying? We got that amount of the entire run. People look at it and say, that's a big old percentage of that run, isn't it? So just by trailing your stop loss up, whether you keep it at the 9 and keeps you in, and that's what trend following does for you. Okay. Hussein, what you say here? Traders dump software stocks as AI fees are up. Yeah, exactly. That was the headline from yesterday, and that's why we saw the sell-off on the indices, particularly Nasdaq. As you saw, we hit 1 point. I'll go back to the daily again. Big old 1.4% sell-off yesterday. Okay, what's that telling me? Well, again, this has been short. This has triggered short. Didn't trigger short there because we hadn't had a cross. Although we were under the 21 day moving average. Here it bounced back. So it was down Thursday, Friday. Bounced back. Hang on. Yeah, bounced back Monday. Then Tuesday was a big sell-off. So that, using this strategy, even though the moving averages are flat, that would have triggered a short position, but it's messy. Like I said at the beginning, because we're consolidating at high, so we haven't got direction. See how the moving averages are waving as we go higher and lower, higher and lower, higher and lower. I was talking about the congestion zone we're in earlier. So yes, yesterday would have been a sell day, and we're down again today. But obviously, you'd be looking to push that to 24,991 close of the day there. And what I was talking about before, the key 25,000 level, which is psychological. And our low we saw in December and in October, October the 10th, when Trump didn't get his peace prize and threatened more tariffs on China. Blah blah, went to 24,000. Bang. And are we going to do it again? Well, the longer this goes on, possibly. But obviously, we've got to breach 25,000 first. So this is short on an end of day basis. But the trend is not clear. So it's a bill. Although it would trigger an entry here yesterday on an end of day basis, it would be a small, simply because there's not a clear trend. We've been up, we've been down, we've been up, we've been down, we've been up, and now we're down. And this could be the end of the dump down. So next look at that. If we don't break 25,000, that's not. It might end up going back up. And remember, what we're coming down from, this is all-time high. Thursday was this time last week, but here, Wednesday, the 27th, we were still going higher. It was all, looking for all-time highs. We got to all-time highs. Final buyers, buyer fatigue, and down we go again, like we did here at the end of October as we went into November. This is key time. It's January. It's earnings season. So yeah, and everything is triggering the market at the moment. We had the commodity sell-off on Monday. We had the software sell-off yesterday. The reading headlines: 30 people killed in Gaza by Israeli missiles today. All of that politics hasn't gone away. Russia has started hitting the energy infrastructure in in Ukraine big time again over the last 2 days. Again, that hasn't made any particular headlines. Situation in Iran, it continues to spiral. They're supposed to be meeting about nuclear uh, uh, missiles, nuclear deterrence on Friday. Whether that meeting actually takes place between Witkoff and the Iranians, talking about falling out. It's supposed to be in Turkey. They want the Iranians want it in Oman or somewhere else in the wider Middle East. So whether that actually takes, so it's adding cranking up. We had that drone shot down by the US aircraft carrier yesterday. So all of that could kick things off again. So just be very careful, my friend, when you've got risk on the market. Remember, you don't make money if you haven't got a trade open, but you can't lose money if you haven't got a trade open either. So is this too risky a market for you to trade? And that's what it's all about. It's all about managing yourself. It's always been about managing yourself and managing your risks. So yeah, stay happy, my friend. If you want any more help, get on our Discord group. And I'm sure, hopefully, you've all been watching our Discord group. But look what we've got here, my friends. Notice board. Oh, it's not on there. Announcements is what I'm looking for. Da, 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 da! MT5 is live. You need a new account. Everybody loves. Love MT5. It's stable. There's all sorts of layouts we can use. I looked at my setup so I can see all the dollar trades, all the sterling trades, all in one screen. You should multiple screens at once. So MT5 is live. Register for an account. You need a new account. It starts from very small a subscription. You obviously build up. Keep your trading view account, your trading view trend locker account. MT5 is a great analysis tool. It's not as techy as C Trader, but that's for the real EA writers. But lots and lots of free EAs on MT5 as well, if that's your way of trading. Really, and that's coming next week. So get registered for that, and we'll be emailing you. Those have already registered from last week. Christian works really hard. Good morning, Christian. Good afternoon. Hope you're well. As it says here, no break migrations to MT5, new accounts. So a lot of you that have registered here. There we go. Click on that account there, the Prop Trade MT5. I thought I took us direct to the MT5, didn't change. So this is the way of doing it. Remember, guys, I put a little video together last week about how you want to, what sort of account you want, whether you want an instant funding one. So we got 4 different types of accounts. Payflex gets you going. Some tight targets here. Let's be honest. 3% drawdown, max drawdown only 6%. Trailing stop loss, cool. Different types of account on Payflex, or you go to the standard, prop trade type classic accounts, the 2-step. 5% and 8%, 5% the first target, 8% on the second target. Drawdown, bigger drawdown. You got there 8%, big old hefty drawdown there, or comfort zone, and then the platform. And we've had Trade Locker since we started. We introduced C Trader towards the end of last year. The techies amongst us. I do like C Trader. I haven't used it, and I should do some of these demonstrations with C Trade as well. But I certainly will be getting a demo account. The boss will give me a demo account on MT5. So MT5 2-step account starts from $79. And obviously, we've got promotions going on all the time. If you're brand new to us, 20% off is available. As it says on our broadcast here, look at the ticker along the bottom. If you put coupon new20, you get a 20% discount. So where is it? Is in there. So one step account. Classic. I'm going to use MT5. 25,000 is the sort of account you want to be looking at. So I'll confirm my selection, and I fill all that in. One code new25 new 20 gets me 20% discount. Like that. Take that. Obviously, it's not going to work because I haven't. There we are. So $40 off the 125. Obviously, change your mind. Take it 2-step, 1-step, 10,000. Whatever you've got, get started. Give it a go. You've got very little to lose, guys, and really prop trading or trading this way through a funded model is, the way forward, and this the route, the ceiling, is there for you, my friend. Hussein, sorry, I've just missed your question. Sorry, my last question. After your last question. A few months ago, dollar index was 108 as countries dumping US bonds. Now the dollar index is 97. What's the future of dollar in the USA? What will be next for global currency? As long as I'm trading, my friends, this is just my prediction. The dollar will remain the global currency of first defense, despite the massive debt in the US as well as other countries. I mean, Japanese debt 250% of GDP, 100 and, I think it's 125% in the USA. I think it is. Um, so yeah, I mean the de-dollarization story will continue. Countries like yourself, India, the Russians, the Chinese, want to talk the dollar down or move to the gold standard. Some people are talking about moving to the gold standard. The buying of the gold by the Russians, the Iranians, the Chinese as well. Has all lifted the gold price that we've seen over the last 2 years, but the dollar will remain the dominant currency. Obviously, in the side track to this is all the digital currencies, the move away from the fiat currencies, all of that trading going on. That is, very, very small still, but it's growing year by year. Sorry, I'm moving away from the microphone. So, just watch and see. Don't get too embroiled in these great big um, events that you can't do anything about. What will be, I hate that phrase. What will be will. Though. So, um, do what you can. Whatever account you take, guys, whatever challenge you take, whatever type of account you have, it's all about staying in business and following the rules. And that's one of the great, great benefits of the proptrade.com. Of us is that the rules are very, very clear. There's no hidden like terms and conditions. You have to go and drill down and ask. Understand. Obviously, it's all written in English. Unfortunately, for many people, English isn't their first language, and so therefore, we try to explain things as quickly, as clearly, and as transparently as possible. And that's what Christian and Toby and the guys and the girls on the support team here on Discard do a really, really good job at explaining everything very clearly and quickly as well. That's the other thing. You do get a response very, very quickly from the guys. So you're absolutely right. So gold, silver, yuan, bricks. Yeah, I mean, bricks maybe will they form a new currency? Possibly. But again, it's something, it's not going to affect the gold price today. It's not going to affect your 5 minute trade. Don't get too worried about it. Don't lie awake at night unless you're writing a thesis about it or something, or studying at university, or it affects your day-to-day business. The world before the dollar, it was on the gold standard. Go back to 1971, and the dollar was freed from the gold standard by Nixon. It's not that long ago. It's quite a long time ago. I was still a young boy in shorts in 1971. Yeah, I think I was still in shorts. Yeah, I was 10 years old. Yeah. So things do change, but it doesn't happen overnight. And the BRICS argument, they tend not to be able to agree between themselves. It's easy to bash the dollar, bash the Americans, bash the West, but the BRICS getting together, and obviously, Russia has invaded its small near neighbour. It's at war, regardless of what Putin might tell you. Do you want to be following those authoritarian regimes? So, anyway, story for another day. Hussein, absolutely no problem, my friend. It's just my take on it. It's not neither right. I'm not going to say it's right or wrong. This is just my views on what's going on. But really, my take as far as 30 odd years of trading these, looking at these charts and trading these, and coming out the other side, making money at the end of the day or the end of the week or the end of the month, which is what it's all about. Trade what you see, not what you think, and don't get too down when you lose. You have a losing streak; it's inevitable. The longer you do it, the longer the losing streak can become. Uh, Simply, don't get too cocky and too clever when you have a winning streak when things are going your way, because that inevitably comes to an end, just like most things in life. Right, it's 2 o'clock here in London. I'm going to go. I've got to go get my dogs. Um, they're in somebody trimming their nails and cleaning their teeth. God bless them. So I need to go. I will see you tomorrow, same time tomorrow for the. Let's have a look. Tomorrow is Thursday, isn't it? So the I don't think we'll get the claims later on in the day, but we'll be live at 11:45 tomorrow. Um, so 11:45 tomorrow for the Bank of England report. I'll then come back to the ECB announcement. Get no excitement with regard the interest rate changes out of London or out of Frankfurt tomorrow. But it'll be really interesting how the vote goes in London. That's what I'm really looking for. Governor Bailey has his press conference this time. At 12:30, and Miss Lagarde, always interesting to listen to. Miss Lagarde fighting off the journalists and telling them how it is. And then later in the day, we got the head of the Bank of Canada, which have just rose, which haven't moved rates, but may have to, and the bank or the head of the Bank of Australia, the RBA, who have just increased rates. So quite a key day tomorrow, 5th of the 2nd, 25. That's interesting, isn't it? It's 2/5/25 tomorrow, or the 5th of the 2nd, 25. So there we go. That's going to be a key day tomorrow. Anyway, I'll leave you on that number. No, Hussein, they probably got more to come, which is why we moved like we did, given that the new Fed chair that takes over in June after Powell steps down in May is very much in line with the president, who wants bigger cuts. And Stephen Myron today, the president's guy, he sort of parachuted into the Fed last year, has resigned from the government officially today, apparently. So whether he's staying on at the Fed or not, I don't think he is. He can't. But yeah, we'll see. But obviously, the key independence of the Fed, which has always kept things nice and balanced and kept markets comfortable, if that starts, the pressure on that starts to be questioned, that freaks markets out as well, because we've got this, the judges, the government, the Fed separate, the judicial, the executive, and whatever the other one's called. But yeah, that's what we're looking for. So yeah, absolutely. Right, that's it. As everybody else, I need to go. I will see you tomorrow, 11:45 GMT. I know you're 5.5 hours ahead, aren't you, in India? Hussein? So that's sort of around your evening tea time after work or whatever you're doing. But keep in touch. Do follow us on our Discord group, and I'll see you all again tomorrow. Take care, everyone. Stay safe. Be good. I'm from the north of England, saying originally. I'm actually living in London at the moment. I spent a lot of time in London. So I'm actually from the northeast of England, little village on the coast. So I do like the sea. Anyway, take care, my friends. I will